Good afternoon, everybody. Good afternoon. Welcome to Admiral's webinar this afternoon. It's Paul here. I hope you can hear me. I hope you can see me. If you're joining us for the first time, you're very, very welcome. If you're watching this on Zoom, or maybe you're on YouTube, okay, you're all very, very welcome. Be sure to subscribe there on the button there beneath our Admiral's YouTube channel. Today, what we're going to be talking about is the first of a couple of parts webinar, which is really about some simple trading strategies for beginners in 2022. So without further ado, let's bring up the slides and have a look at that. And then what we'll do is, if there's time at the end, I'll switch across to the Admiral's platforms and we will have a look on the live chart to see what, if anything, was setting up this particular morning. So just bear with us and we'll bring up the slides and crack on. Here we go. Hopefully that will. Super. So let's just move this out of the way here. Okay. Great. Okay. Fantastic. Thank you, Michael. Great to see you here. Great to see Tina. Okay. Great to see everybody here. As I said, we're going to talk about simple trading strategies for beginners in 2022. I appreciate that when we have our webinars here, that there's always a broad range of experience in the room, from people who are complete beginners to people who are trading quite experienced, and hopefully there'll be a little something for everybody to be able to take away. But we want to focus on just providing over this and a couple of other webinars I'll do over the next month or so, just a few simple ideas and concepts that you can take away and utilize if you're a new trader. I also recognize that we have a very global audience here. Even though this is the English-speaking audience, I appreciate we have people who join us from all over the globe. You're all very, very welcome. Feel free to sort of put your questions in the chat box, or as I said, if you're watching this later on demand on YouTube, stick a comment in the commentary box. Okay, maybe you have ideas or thoughts about future sessions you'd like to see us do. That's absolutely wonderful, and we will greatly take on board any particular ideas and thoughts you may have. So yeah, trading strategies for beginners in 22. Maybe you've been operating with a couple of strategies already. It'd be great to hear what they have been. Okay, been great to hear what you've found has worked for you, or maybe you've challenged by. I'm very happy to take that on board, okay, because I can build that into the future sessions we do. So here we are. Admiral's a Forex and CFD broker that has a global presence, but with local support. Licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing the opportunity to engage with markets using both MT4 and MT5 platform. If you have any questions about Admirals, get in touch with your account representative and they'll be very happy to help guide you. Also, if you want to get more information from ourselves, okay, more up-to-date sort of insight and commentary and content on markets, then be sure to subscribe to our Telegram channel there at Admirals, as you see, if you haven't done so already. My wonderful assistant, will put a link up there, hopefully, in the box that will allow you to just click on there and join that. There you go. It was wonderful. Thank you very much. For that, but as I said, it's more up-to-date insight, commentary and content that you can catch just straight on our Telegram channel. So what am I going to talk about today? As I said, today is mostly for beginners. So I'm going to talk about a little bit about understanding market environments. I'm going to talk a little bit about the different types of trading methods available. Talk about, a little bit about which ones, how to decide which one suits you, how to trade through different environments and methods. And as I said, I'm going to share with you one particular setup today that you can take away, all right, and utilize in your own trading. Called the Fiery Cross. Okay, you might have heard me talking about it on Marcus's Good Morning show this morning. Thanks to those of you who joined us there. But we'll be talking about that. And as I said, if there is a time at the end, we'll switch across to the live charts and take a look there as well. For those of you who don't know me, my name's Paul. I've traded for many years, okay? Primarily, I look to trade FX indices and commodities. They're my sort of main aims. And I tend to be a trend trader from a longer term positions and a sort of a mean reversal trader for my shorter term positions. So here we go. Simple trading strategies for beginners in 2022. As the slide says, We often see that many new traders are looking for complicated trading strategies when they begin their trading journeys. In reality, it is often the simpler methods that help them as they learn to trade at the beginning of their careers. And I said, this is part one of 2 sessions. We're just looking at simple trading methods that you can utilize in the coming new year. And in this session, we'll look at, we'll just look at what simple trading method beginners can employ to help them engage with and trade markets successfully. It's absolutely true that very often, new traders look to overcomplicate their trading processes, their trading routines, their trading setups. I can say that because I was guilty of it myself, all those many years ago. But what we find is that actually less is more, all right? It's better to have a simple plan that you can execute clearly rather than a really complicated plan that you struggle to execute, It's always better to have a simple plan that you can execute clearly. And what you will find is that, especially if you engage in intraday trading, that tends to suit that even more, because things are happening fast. And what we want to be able to do is to be able to just, identify a setup and make a quick decision and take the trade. So, for beginners, for absolute beginners traders, who I say, I appreciate we have a good majority of our crowd. It helps, I want to sort of build up a little bit of your knowledge, your experience, I want to build up your kind of ability to analyze markets, and effectively to, but in a kind of a part of a simple routine. What I talk about is, trying to understand the phases of the markets, and generally kind of look to have, markets being in, I would say, say 5 phases to begin with. As you can see there on the left-hand side, we've got a downtrend. On the right-hand side, we've got an uptrend, and in the middle, we've got sideways markets. And I say this all the time. Good trends, should leap off the chart at you. You can see for the downtrend and the uptrend, you have to excuse my drawing. I'm a better trader than I am an artist, ladies and gentlemen, right? But hopefully get the main message, which is good trends leap off the chart for you. Don't force it, If you're looking at a chart and you're struggling to see if there's a trend in place, the reality is there probably isn't one there, all right? Good trends will leap off the chart. And a lot of the time, markets, spend their time choppy, going sideways, consolidating, or maybe transitioning, which we'll come on to. Markets tend to only trend for maybe 20 to 30% of the time. So if you're looking at charts and you're struggling to find one that is trending, it's not a reflection of you, or your skills as an analyst. It might just simply be that the markets are going sideways that particular period of time, for whatever that might be. But if you're a new beginner trader, just being able to even just start to identify and understand the phases of the market will help put you in a better place, because then you can start to focus your trading method down on which way should you sort of engage with that market based upon the particular phase it's in. The next 2 phases of markets I would call are, where markets are transitioning, right? In this particular case, you've got either a market that is transitioning from a downtrend, into an uptrend, or alternatively, you've got a market that has been in an uptrend, but is now actually sort of transitioning into a downtrend, Sometimes that's very clear. Sometimes it provides really nice reversal patterns like head and shoulders, double tops, triple tops, wedges, etc. Other times, transitioning out of one trend to another can be very scrappy. It can be very choppy, because there's people, repositioning, there's people stops being hit, people putting on new orders, there's other people taking profits, invariably, that can make it quite a choppy, transition. Once again, if you're a new trader, and you're seeing that your market is transitioning at the end of a trend, that's okay. That's okay. You can just sit and wait for it to show its, to basically to play its hand, to show which way it wants to go next. All right. There's nothing that says you have to fight the market. In fact, I can give you one little guarantee, is that, if you try to fight the market, you are probably more likely going to lose. So don't fight it. All right. If the market's choppy, if it's indecipherable, if you're struggling to understand it as a new trader, then just step back. There are plenty of trading instruments on the Admirals platforms that you can go and work with. There's nothing that says you have to sort of just stick to the one instrument or the one time frame. All right. If it's in a choppy sideways, or it's transitioning, go and leave it and go find something else. Okay, that's absolutely fine. There's absolutely fine with that. So those are the kind of the phases of the markets. And as I said, for a new beginner, if you can get good at identifying, which phase the market's in, starts to give you a little bit of a help, starts to give you just a little bit of, a little bit of a starting point from which to work. And then, then you're going to go down. Once you've identified the market environment, you're going to look to go down and say, well, actually, what trading method, either A, what trading method should I use? Or, is that market reflective of my preferred trading method? Now, I know those of you who've joined me plenty of times will have seen me talk about this before, is that, if you go onto internet or trading forums, trading websites, you will find there are thousands and thousands of trading and investing methods out there, all right? Just thousands of them of all sorts. Some very simple, some very complex, some cheap, some not so cheap, all right? There's thousands of them, literally thousands of them. But my view is that generally they all boil down to one of two trading method styles, all right? You are trading, all right? You are trading either a break of a line of support or resistance, or you're trading a bounce off a line of support or resistance. And it's as simple as that. I mean, there are lots of different, lots of very different, lots of kind of, sort of, let's say, nuanced areas of that and different sort of trading styles. But the truth is that, when you start to break it down, just keep it simple, ladies and gentlemen, and it becomes that kind of a break of a line of support resistance or a bounce off a line of support resistance. Let's keep it as nice and as simple as we possibly can there. So here's a little example, very, it's an old example, but it's a simple example. You're trading a break of a level of support or resistance. Namely, that invariably what we're seeing here is that, this is a 15-minute chart on the US dollar, and we have resistance to the top, which we can identify. And we can also draw that line in to identify resistance. And we can also identify our support there, okay? There you go. You can see for that period, and it's a 15-minute chart. Price was going sideways, wasn't it? Okay, yeah, just basically it's going sideways, and then it breaks and it collapses, as you see, okay? You traded, in that particular instance, a break of the line of support, okay? So it's, that's what a lot of them are doing, breakouts, okay, in terms of breaks of lines of support resistance. Or alternatively, you're trading a bounce off a level or a line of support or resistance. This is euro dollar on the daily chart. I mean, you can see the price is in a pretty strong trend. Remember what I was saying earlier, that, when, a good trend should leap off the charts, you don't try to fight it. And actually what we see is, you can actually see here, let's get the old drawing tool up here, is what we can see is that, as price is in that downtrend, we can see that actually as price pulls back, it keeps basically bouncing off either levels of support resistance or off, in this particular case, the 50-period moving average, the red, which is known as dynamic, in this case, dynamic resistance. You can see it happens there 2, 3, 4, 5 times, okay? And so that's it, and so, as I said, it's, there's lots of nuances to that. There's lots of little different styles of it, but really, ultimately, that's what you're doing. You're trading a breakout or a bounce off a level of support and resistance. So here's another chart. I always put this chart in because actually, I think it's a great chart to look at. It's Kiwi dollar against the Japanese yen on a weekly chart. And it just shows how in that particular instance, the price actually just went sideways effectively for what was getting towards close to 3-4 years. All right, you could see it had support at 58 and horizontal resistance at 69, and price continuously bounced back and forth between them, there and such. And that was, that in itself was tradable. Okay, it was, clearly the phase of the market was in sideways. But then even then at the end, okay, price broke out. It broke the level of resistance at 69 before it started that new particular trend. So, this kind of understanding this, how these markets work, it doesn't really matter whether you're looking at a 1-minute chart or a monthly chart, or in this case, a weekly chart, okay? You'll find, there's people trading, they're trading either a bounce off a level of support resistance or a break of a level of support resistance, all right? And so, as I said, if you're a beginner trader, it can sometimes be a bit complex, it can be a little bit overwhelming. Well, then actually this is an opportunity for you to just basically just be just relax, okay? Take a look, take a step out, okay? Just realize that, keep it simple. People are trading either, a bounce of a level of support resistance or a break of a level of support resistance, okay? And now, once again, if that's your starting point, That's a good point from which you can go forward from. So, you know, when that comes to basically talking about, you know, trading strategies, you know, and those kind of setups we just talked about, I always say, you know, they both have their pros and cons. There is no perfection in trading. All right, ladies and gentlemen, there is no perfection. Okay. Some people prefer trading breakouts. Some people prefer trading bounces. All right. And they will have their own, you know, they will have their reasons for it. Personally, I tend to prefer bounces, all right, as part of a pullback in a trend, in a new trend. The reason being is that I believe it gives me an opportunity to enter at a better price, which means that my, you know, my trade risk might be smaller, my reward to risk ratio might be more achievable. But equally also, if the trade isn't going to work out, I know that I'm wrong far sooner, which might sound a bit strange that a trader's saying that. But, you know, I've often said it's not merely financial capital you put at risk, you put emotional capital. And if my trade plan isn't going to work out because the market is dynamic and it's fluid and it's changing, well, then if I'm wrong, I'd sooner know I'm wrong far sooner, because then I can cut the trade, reset myself and go again. So what we're going to do today, all right, today we're just going to focus on one simple strategy for beginners, all right, and to take away and use, you know, for the last few weeks of this year and into 2022. And we're going to call this the fiery cross. And it is it's a simple version of using bounces of support and resistance. Okay, just a nice simple way where actually what we're going to do is going to bring together 2 or 3 elements all together that will give us just a confluence of events. Those of you who've joined me before, you'll know that I talk about that all the time, confluence of events occurring, because you just want, you know, 2 or 3, 4 things coming together at one time and place, which will help you enormously. So buckle up, ladies and gentlemen. Here's where you might want to take a pen and paper to make a few notes, although I will also add that, you know, this video is recorded and will be on the YouTube channel. But I think actually sometimes, as I do myself here, is that, you know, when you actually write down notes as you go, it kind of, for me, it kind of makes it a little bit more solid. So what is the fiery cross setup? For me, I would then call it a subjective trade setup as opposed to a mechanical or a purely discretionary one. Subjective because what's happening is you're utilizing, you know, a couple of simple concepts that you might already know or you're about to learn that provide you an entry into a possible new trend. Okay, and it's subjective just because there's 2, 3, 4 things come together, and when they do, that is when your trade is on. All right, okay, it's not a purely mechanical setup. It's not a purely discretionary one either. It, you know, there's 2 or 3 things to happen, and you need just a little bit of make a little bit of decision. But it's quite a simple decision to make. What is good about this, and what, you know, about all of the ideas and concepts that I share with you myself, is that it is time frame and instrument agnostic. You know, meaning it sets up across the spectrum, ladies and gentlemen, right? It sets up across the spectrum. So it doesn't matter if you're trading, you know, weekly charts on copper or, you know, 1-minute charts on euro dollar. Okay, it is time frame and instrument agnostic. So you'll see these setups occur again and again across all time frames and instruments. And I think sometimes that can help new beginners, because actually, you know, you just know what you're looking for, and that allows you to basically see the setup. And if it's there, there's a trade on. If the setup doesn't occur, then you just move on. Today, in my examples, I'm going to focus on the Forex market because that's what I trade the most. That's what I, you know, utilize it in the most. But as I said, you know, you'll find the setup, because it is actually quite simple. You know, you'll look to utilize that across all manner of time frames and instruments. And what it is it's I'm looking to use it to identify the possible start of a new trend. Right, that's it. You know, it's, as I said, there's nothing that's 100% certainty in trading. There is no perfection. But when they're set up, it's a good trigger. It's a good example. It's a good opportunity to get into a trade, and when it runs, it will run well for you. So as I said, you know, you can utilize it across all sorts of time frames, you know, weekly, daily, 4 hourly, if you're a swing trader or an intraday trader, 60, 30 minutes, 15 and 5 minutes. But you could use it on the 1-minute chart, but I wouldn't suggest you as a beginner do that. I actually find that kind of the 30-minute chart for lots of traders, 30-minute charts is kind of the, I'll describe that as kind of the Goldilocks. All right, it's kind of like the Goldilocks time window. Okay, you know, it's not too slow, right, and it's not too fast. Okay, there are enough repetitions or frequencies of the actual event happening to give us that chance to basically to take that trade. And the setup is quite simple. You know, it's the same charting setup that you see I utilize across all of my charts that I put up here, where I'm just using a blue 20-period simple moving average, a red 50-period moving average, and a green 200-period moving average. But really, it's the 20 and the 50 that it focuses about here, ladies and gentlemen. Let's keep that kind of simple. So, what is the actual setup? You know, part one is that simple setup. What we're looking at is we're going to utilize the cross of the 20-period moving average and the 50-period moving average as our first filter. Okay, if you've heard me talk about it before, you know, I don't particularly like people just trading arbitrarily moving average crossovers. I don't particularly believe in that at all. But this is just being used as a filter, and I use it as a filter in quite a few sort of simple trading ideas. And what we're looking to do is use across the 20 blue and the 50 red moving averages. So, you know, just even on this chart here, you can see price has been doing its thing. Here we have the red 50, here we have the blue 20, and what we actually see is, you know, the blue, okay, crosses, the faster one crosses beneath the slower moving average. So we're actually looking, okay, once we see that happen, that gives us the filter. We're looking to be a short, okay, we're looking to sell the market in this particular example. So, as I said, that's kind of the first part. Here's the interesting second part, which has come from years of my own observations and years from trading, is that very often, not all the time, but very often, you find that as those moving averages cross, that what we'll find is price will trade up into the region where price has crossed. Okay, and once that occurs, we take an interest. If that doesn't occur, we don't take an interest. This is the sort of, you know, this is the element of subjectivity, as in, you know, it has to do this. Okay, you know, we can see here in this particular case, we know that the 20 is crossed south of the 50, so we want to be a shorter. Price is already beneath it, and then what happens is, see how, you know, we've got the area, okay, where it's crossed. What does price do? Price actually rallies back up into that area. Why does that happen? I don't know. You can find your own narrative. My view might be that the 20-period moving average, 21-period moving average is very, very popular with traders, very, very popular with very simple buy and sell programs. Very often you'll see very simple buy and sell programs that will literally, you know, sell price as it comes up to the 21 from beneath, or will buy it as price comes down to the 20-period moving average from above. Very simple, okay, you know, and there might be other reasons why that happens, but all we're interested in is that it does happen. Okay, is that it does happen, and hopefully you can see there price does rally back up into the area where, you know, where the moving averages are crossing. Once it does that, we take an interest. Remember what I said, if it doesn't happen, if, you know, I don't know, if price had just literally continued dropping, it's of no interest. Okay, it's of no interest to us at all. So that's part two. Part three here is that, you know, once price has traded towards the area of the cross, it is often rejected. Okay, it is often rejected at the area of the moving averages. When price prints a rejection candle, or, you know, in particular a pin bar, then this is our trigger. Okay, that's our trigger. So remember what we're saying, you know, we're needing 2 or 3 things to come together: moving averages to cross, price to rally up, you know, trade up into those moving averages, and then to reject it. Okay, then to reject it and print, you know, a pin bar or a rejection candle. And that's what we have in this example. The average is crossed, price is traded up, then what happens when it gets there? It gets rejected. Okay, and it prints a very nice, very clean, very ear pin bar. That's our trigger. The trade is on, ladies and gentlemen. Moving averages cross, price trades into the area, prints a rejection candle. There you go. Simple. All right, and it's subjective because it only works if all those 3 things happen. If it doesn't, there is no trade. All right, there is no trade. What we like to have is, okay, you know, for new traders, I'd be suggesting you trade the break of the candle, okay, break of the rejection candle there in the direction of the new trend. We know we want to be a short trend. We have our stop loss above the rejection candle, and that will depend upon, you know, If you're trading that on a monthly chart, okay, that might, or a weekly chart, you know, your stop loss is going to be a little bit further above the rejection candle. Whereas if you're trading on a, you know, a 30-minute candle, I would normally say, you know, just 2 pips plus the spread would be enough on a tighter thing. Our stop loss is above the rejection candle, and what I always say is, you know, you should be wanting to target at least 2 to 1. Okay, some people like 1.5 to 1, but my normal suggestion is, you know, target at least 2 to 1. Some people will actually like to run a trade setup as long as they can. They might want to use a simple trailing stop. They might want to trail it on like a simple 3-bar trailing stop. That is absolutely fine as well. Okay, that's, you know, I'm absolutely happy with that. No bother at all whatsoever. For those of you who are completely new, you know, and just might not, you know, fully understand what a pin bar or rejection candle is, here's some examples. Okay, these would be bullish ones, because what we're actually expecting is we're expecting price to have sort of traded down and then basically bounce and move up. Okay, that's what we're actually looking for. Now, you know, those would be termed as bullish pin bars, bullish rejection candles. These 3 would be bearish, because it actually is when, you know, prices are coming on an uptrend, and then basically you can see price pushes up, gets pushed down, and then away it goes. Same with this one, away it goes. Same as that one, away it goes. If you are completely new and don't fully understand pin bars, if you go into the YouTube Admirals channel, you'll find that there are actually 1 or 2, in fact there's probably more than that, quite a few videos there now on different types of price action, and also price action combinations, and on also trading pin bars as well. So be sure to go and look at that if you want to, you know, into more depth, more detail about trading pin bars. So, you know, that's the setup. So, you know, I figure with the setup in mind, why don't I show you some examples? That's always what helps. And I've tried to put in, you know, I trade a lot of sterling, but, you know, I've put in quite a few different examples across different time frames in a couple of different instruments, just to show you that, you know, when it sets up, we have a trade on, you know, and a recent one here on the, this is the weekly chart. Okay, remember what I said, it's across all time frames, across all instruments. You know, you might already be able to see it yourself here, is that, you know, the 20 had gone sideways, the 50 had basically started to taper off. And then what happens is price comes down here, doesn't it? And as price crosses there, the 20 crosses the 50, what had happened for the couple of weeks before? Price had rallied up into that area, hadn't it? And it printed, you know, not 1, but actually 2 rejection candles. Okay, you know, we're trading the stop of that, and you can see not only did it make its 2 to 1, but actually, yeah, price continued all the way down there. Okay, and it's still around about there at the moment. So remember those 3 simple things: the 20 crossing the 50 period moving average, price rallying into that area, price then printing a rejection candle. All right, those 3 things coming together, nice and simple. The trade is either there or it's not. All right, just keep it nice and simple. And hopefully you can, I'm hoping that you can actually see that there, you know, and based upon that and what we've told you, know, you have to ask yourself, you know, would this be a trading method that you could follow? Is it simple enough? Is it, you know, is it pretty clear? Remember what I said, you know, you'll find those 20 and 50 moving averages cross when they need to, but does the price rally into the area? If it doesn't, there's no setup at all. And if it does rally into that area, then does it print a rejection candle, a very clear, nice one? A lot of the time it won't, but when it does, that's your trade. Okay, the trade is on, ladies and gentlemen, and that's what we're particularly looking for. Remo's asking, do we put our trade profit at the support of the 200 period moving average? That might be your choice. You know, generally what I say is normally, you know, about 2 to 1. Okay, but as I said, some people would like to sort of run the trade as long as possible. Other people might see the 200 period moving average as a very natural target point, and I would, you know, if you'd had that target point there, you know, I wouldn't be, you know, I wouldn't be complaining with you. You know, I wouldn't be giving you a hard time about it. That is it's a natural point. You know, I'm always looking at, you know, I might have targets in my trade, but I'm also aware of what there might be like natural decision points as the trade goes along in its way. Okay, and you will find that, and you see how the market reacts at that particular decision point. William's asking, Paul, what's your opinion where GBP will go later in the week? I'm set on long. Good question, William. It's probably a little bit outside the scope of today's session. My own view is that you know, we've had a little bit of a risk on, you know, there's been a little bit of a kind of a risk on flurry the last couple of days. which will have put a little bit of wind in the sails of the GBP. But actually, at the moment, for those of you, we're going through a little bit of a political squall, shall we say, and I think that will, that will impact upon Boris Johnson, and with that creates a level of uncertainty, and markets hate uncertainty. So, I would be, I think we're in for a little bit of a skittish week. Would be my answer to that, William. Hope that helps. So here's another example: pound against US dollar, but this time it's on the 30-minute chart. Okay, it's on the 30-minute chart here, and this is how it happens. This is the overnight. This is the overnight Asian session for me. Okay, so I'm not really trading from around about there. But then what happens is, the next morning as I come down, what we see is that, the 20 crosses the 50 as it has done. The price has actually rallied, price has collapsed into that area. It's actually printed a key reverse, which is another thing. And then what do we have is that, it's showing as a rejection candle. During that period, price had tried to push up, but it couldn't, and it had fallen and collapsed and closed on its lows before the price, the trade, ran very, very nicely. I think your 2-to-1 was just in front of the previous day's lows, but just to make the comment before, it actually, the 200 period moving average was a nice target, but actually even went much further. That's what sometimes happens. Sometimes markets will move, much further than you think. Other times they won't. Welcome to trading, ladies and gentlemen. So that's it. You're welcome, William. Thank you. Here's an example. As I said, I trade a lot of sterling. Okay, so here's an example. This is a 15-minute chart on the pound against the Aussie. It's been in a bit of a downtrend there. Okay, it started to put in a bit of a reversal pattern there, but that's overnight. That's kind of overnight the Asian session. What happens here? Okay, what we see here is the 20. Okay, has started to cross above the 50 period moving average, hasn't it? Price had already rallied up, but then price drops into that zone, doesn't it? And then what does it do? It prints, a rejection candle. Even though it's a bearish close, that is a bullish pin bar, so you're long that trade with your stop loss beneath the low, and your target is 2-to-1. But as you can see, it actually ran and ran. So I'm just suggesting 2-to-1 as a target, because I think it's always important to get asymmetric reward to risk ratios. I think that helps enormously. But I appreciate more experienced traders joining us might see this and think, well, there's ways that I could run that trade longer, and that's perfectly fine. And what I want is for beginners to have a simple setup that they know where they're getting in, they know where they're getting out if they're wrong, and they know where their target is. Okay, so it's almost like a sandbox trader, which is actually really good to help new traders in terms of recognizing and building routines, building good processes. Just effectively the traders on, and they don't interfere with the trade. Let the trade play out and do its thing. So William's saying, hi Paul, just wondering how do I set up a moving average on my MetaTrader platform? Okay, no, these are these are not paid indicators in any way at all, William. These are simple standalone indicators that you will find on the MetaTrader platform, and if there's time, we'll show you at the end just to be how you can actually find these. It's just the as I said, my charts, what you'll see, you've got the blue 20, the red 50, the green 200. I also have fractals on here, but which are useful for me, but they're not relevant to this particular setup. And you'll, on my intraday trading, I have indicators to print the kind of previous day's highs and lows. But once again, that's not really relevant to this particular trade setup either. All it is the 20, the 50, and understanding the price action. Okay, that's the main element of it. Nice, simple one for traders to begin with. And here's a similar one. This is the euro against the sterling on the 15-minute chart. We can see price has been going sideways. The 20 has been beneath the 50. And then what happens here is the price actually, it crosses, doesn't it? Price tries to pull away, but then what does it do? It kind of, as I said, it sort of, pulls back into that area. I prefer it when the price does that right as close to the cross as possible, but sometimes it might take, 3 or 4 candles, all right? It's just looking at the price action. What is the market telling you? But, when it gets there, what does it do? It puts us in, gives you not 1, but 2 rejection candles of that whole zone area before price runs away very nicely. And just as an aside, what you can see is later in the day, well, that's later in the day, it actually crosses back as well, doesn't it? But there is price hasn't really rallied up into that area, has there? Didn't really rally up into that area. There's no trade. Remember, moving average cross, price rallies into the area, then it prints a rejection candle. If it doesn't do, you know, the other two after the moving average is crossed, there's no trade. So it kind of, as I said, it kind of makes it simple. If it doesn't do those three things, there ain't no trade. This is an example on, this is the Swiss against the Japanese yen, okay, on the 4-hour chart here. As I said, I've put in quite a few examples because I think it always helps just to be able to see how it plays out. I think I've got one or two, you know, where actually, you know, it didn't trigger, which we'll look at in a moment, just to, you know, just to show you that there's no perfection, all right? But actually, you know, once you start to be able to recognize and see this, there's a super opportunity for you, namely, you know, prices topped out here, okay, that week. It's starting to make lower highs, okay, it rallies down, it's beneath the moving averages, and then what happens is, you know, we have here, you know, the 20-period moving averages cross beneath the 50, so we want to look for shorts. Same time, price rallies up into the area, into the moving averages, prints that really nice, okay, that really nice pin bar, rejection candle, and then price, you know, falls away, doesn't it, for pretty much for the best part of the rest of that week, okay, making your 2-to-1 trade, okay, quite happily there. So as I said, all sorts of instruments, all sorts of time frames, okay, when this happens, it'll occur. The only challenge is that I can't tell you, oh, well, do you know what, every Tuesday afternoon between 2 and 4, that's when the trade happens. I wish I could, I wish it was like that. It doesn't. It happens when the market is flowing the way it wants, okay? And as I said at the start, you know, don't be fighting the markets, okay? Think of you more like a surfer, and the market is the ocean, all right? The ocean is just doing its thing. It's going back and forth, back and forth. It's your job just to find good times and places where to actually get on and surf the best waves that you possibly can. So this is an example on, this is the Kiwi dollar against the Japanese yen on the daily chart. Price is topped out. It's, you know, it's coming down already. It's starting to get beneath the moving averages. And as you can see, you know, as it's crossing here, price, you know, rallies back up into it. It's also where the 200 was as well. Now this isn't a, you know, a pin bar, all right, exactly. It's normally pin bars that we see, but that is most definitely, you know, a rejection candle. Price is trying to trade up during that session, and then it has just literally collapsed, okay, and it's closed right down its lows. It's a very strong bearish candle, a real rejection candle. So price has told us what it wants, all right? Prices, you know, it's told us what it wants to do, and as I said, you don't want to fight it, you want to surf that, and as you can see, that price actually just moved down quite nicely. And where did it go? Well, it went to the 200-period moving average. There might be some long-term targets some of you might want to consider utilizing for that if you as you take on board and use this for yourselves. So I've just a couple of questions here. Is yeah, so, you know, William, you're welcome. William says, I follow Marcus's advice, take half or 2/3 of a profit and set the stop loss higher. That is, you know, I'm not necessarily against that, okay? I'm not necessarily against that. Certainly, you know, you never trade without a stop loss, okay? But what I think about this is a case of, you know, you see the trade is either there or it's not. You set the trade and the trade plays out, okay? What I find is for new traders, you know, they take a little bit of profit because it makes them feel good. All right, gives them feel good, makes them feel like, you know, they're winning, makes them feel, you know, special. But what I can find is that sometimes for some traders that can set the wrong habits, because actually as soon as a trade goes 10 pips or so in their direction, they're trying to snatch a profit because they think that's a good thing. Whereas actually, you know, it's about having a plan. And if your plan is to take half your position off at you know, 2-to-1 and let the rest run, then that's absolutely fine. And just, you know, part of this, as I said, is about not overcomplicating a plan, keeping a plan as simple as you can, because actually a simple plan is easier for you to follow. Michael says, Paul, I'm right that this is always a trend following setup. Primarily yes, because what we're looking to do is, you know, as those moving averages are looking to cross, what we're looking at is this is an opportunity to join what might be the start of a new trend. Okay, so very, very experienced traders very experienced, let's get the old tool, very experienced traders, might have been able to recognize that, that kind of a reversal there, okay? But when you're a new trader, you're building your skills and you're building your analysis abilities, that's not always, you're not always going to see that, because you're still learning there. You're still going through, it's like unwrapping the layers of an onion, okay, in terms of, building your knowledge and experience. Whereas, something like this is that, it's simple, as in, you're not doing anything until that moving averages cross, those 20 and 50 period moving averages cross. That's when you begin interested. Second point is, has price rallied into that area, into that zone where the cross has happened? If it hasn't, there is no interest. If it is, there is interest. And thirdly, once it's there, does it print a rejection candle? Does it print, a rejection candle, a pin bar? If it does, there's your trade trigger. Okay, you stop, the other side of the pin bar, and you target two R away, 2 times your trade risk away. And you can almost like set that trade and forget it and walk away from it, so long as that is all set up on your platform. And in some ways that's good for new traders. It's a simple plan that you can follow effectively. I've just put in quite a few examples here. This is Kiwi against the Swiss franc here. You can see that price has been rolling over, price gets beneath the averages, and then we see here the price is crossing, and what happens is price rallies back up and it puts in a rejection candle there. Now, preferably I would have preferred the rejection candle to be 1 or 2 candles along, just to confirm that the averages have crossed. But sometimes you'll see as your price action reading knowledge increases, that you'll notice that price is rallying up into that zone. And when as I said, it's that rejection candle. Okay, it's that kind of rejection candle that we're seeing there up at that zone before the price moves away. And that that's a Swiss, it's a 4-hour chart, and that ran quite significantly, as you said. So saying to answering Michael's question and stuff, is that this is what we're hoping here, is that this is an opportunity to join what might be the start of a new trend. There's no perfection, it won't always be, but when it does work like that, you can see that that's a trend for you to try and run, isn't it? And here's a short-term example one. Okay, this is the Aussie dollar against the 30-minute on the 30-minute chart, and we had a cross there at that night, but it took a while for price to rally back into that area. And to be honest, this is overnight in the Asian session. I'm not trading it anyway. All right, I'm not trading there anyway. But next morning's okay, as it opens, what do we see is that the moving average is crossed, and the 20 is crossed beneath the 50, so we're looking to short. And at the same time, what we saw was the price was rallying back up into that area. And then what does it do? It prints a nice pin bar, a nice bearish rejection candle. It actually turns into what's known as like a 1, 2, 3 double top. It prints a second one before price dropped there. Okay, so as I said, across all time frames, across all instruments, the setup is kind of simple, right? It's kind of simple to recognize, and it is either there or it's not. Moving averages have crossed, price has rallied into that zone, printed a rejection candle. That's it. If it doesn't do that, there's no trade for you, and that's fine. Just move along, go and look elsewhere. Okay, Admirals provide a wide range of trading instruments, so there's lots of opportunity for you to get on board that. So there you go, ladies and gentlemen. In conclusion, many new traders overcomplicate their life by trying to trade complicated trading strategies, when following a simple plan would probably help them more. There are thousands of trading strategies out there, but they tend to boil down to either a bounce of a support resistance or a break of a support resistance. The fiery cross combines a moving average cross, a rejection of an area, and a price action candlestick. It's the bounce, you're trading a bounce off that area, off that sort of what would be, the moving averages acting as support resistance. Gives us a confluence of events because you've got 3 things coming together, and it can be used across all instruments and all time frames. So if you've got any questions, you can always go onto the website. You can email us at global@admiralmarkets.com. We've got like literally a minute or 2 left. So what we'll do is I'll switch across the charts and just have a little look at what was going on today. There was a few, I'll just look at the euros, okay, and stuff. So bear with us a minute. Let's just go across. So just let's see if I can bring it up really quickly for you here. So here we go. Boom. All right, so I'm hoping you can still see me, hoping you can still hear me, hoping you see this is the Admiral chart. Here we go. Euro against Swiss franc in the weekly chart. Firstly, all right. I think it was Michael who was asking about moving averages. This is the MT4, but MT5 is not really different. What you should be able to do is see, go up to insert, okay, indicators, go down to, I think it'll be under trend. There you go, moving average. All right, so insert indicators, trend, moving average, and then once it's there, you can amend the moving averages and choose what colors, what, you know, whatever you particularly want to have in there. But what we're looking for is, and this one is a blue 20 period simple, a red 50 simple, and a green 200. And you know what I wanted to show here is that this kind of is a messy example, because, you know, I don't want to show, you know, everything's pretty, but we can see here, see how price crossed there, and what was actually happening is we saw price rallied up into the area, printed a nice, there you go, a nice bar there, and actually it wasn't really, the next week price tried to push up, but it didn't. It fell down. Your trade wouldn't have been triggered. It would have been triggered the week after, okay? And then what we had was another kind of rejection candle showing us that basically that how price was sort of dropping there, okay? So sometimes they're not always pretty, okay? Sometimes it's not always pretty. We can see here actually when here on the price crossing the 20 above the 50, price did collapse back into the area, but it didn't really give me a particularly bullish candle. Now, some would say, well, that was very bullish engulfing, but, you know, this is a weekly chart. That was about 5-6 weeks later. Okay, all right. You know, there was nothing really terribly pretty or clear there, and that's what I'm looking for. That's what I'm looking for in general. If it's, you know, if it's not there, if it's not, you know, just particularly move on to it. So, so yeah, that was Euro against Swiss franc, and I hope that helps you. Now let's have a look. Did one? Yeah, I think Euro New Zealand dollar was working on it. Yep, there we go. So Euro New Zealand dollar, I said that the 30-minute chart could be kind of nice for you there, okay, in that particular times, because there you go, and because actually I'll come back to that in a moment, is that, here you go, let's get the old drawing tool is here. So this was this morning, okay, this is the euro against the New Zealand dollar. As I said, on an intraday basis, 30-minute chart kind of works nice. The previous day price had come down and it doubled, bottomed, and price had come up, and then what we had here, price has crossed there, hasn't it? Price is kind of, you know, you can see it's come down into that area, hasn't it, to retest it, and then, you know, it's actually printed a couple of bullish pin bars there, hasn't it, before price rallied off. It's rallied its way off there. Okay, so that was just a simple example from today, you know, from earlier today, where it actually triggered and traded and it had gone up. And I remember I was saying the 200 period moving average is here, and that's kind of a decision point there, you know, around about where your target, your target would be as well. All right, don't be the old trading saying goes, don't be a dick for a tick. Okay, as they say. Yeah. Anyway, less of that. So there you go, ladies and gentlemen. I hope you found that. Hope you found that kind of useful. I hope you found that good for you. As I said, it's about having a simple idea that you can take away, utilize tomorrow, and actually take forward in your own particular trading. And we'll do a couple more of them over the next few weeks, maybe next sort of 6 weeks or so, myself and my colleagues Marcus and Jens. As I said, if you're watching this on the sort of YouTube channel afterwards, then please, you know, if it's been useful to us, give us a like up. Make sure you subscribe to the channel as well. William says, Paul, this webinar worked perfect because a while ago I followed your webinar from YouTube, past webinars, and now I'm using it also. Thank you, because it's profitable for 70% of the time. There you go. That's great feedback, William. That's lovely. That's thank you very much. It's great to hear that, you know, people are taking on board what I'm sharing and actually utilizing it in their own trading. That's fantastic. I'm really chuffed to hear that, William. Long may it continue for you. So just one quick moment is that after this webinar ends, you'll probably find yourself, you'll get a survey sent, what you thought about this webinar. It'd be fantastic. Please feel free to give that in and give some feedback. It helps us. If you've got ideas for other topics you'd like to see us cover, that's fantastic. We'd love to hear that as well. And other than that, it just remains for me to say that, you know, I wish you the very best of success in your own trading endeavors, ladies and gentlemen, and I look forward to seeing you soon. Trade well, everybody. Cheers.